Hello, everyone, and welcome. Thank you so much for watching or listening to the podcast today. Oil just shattered the $100 ceiling, and the global economy is staring down a perfect storm. The Strait of Hormuz is effectively closed, and the world's top economists are officially sounding the alarm. Is this a replay of the 1970s or something much worse? Today, we're breaking down the black box warnings from names like Paul Krugman and Peter Schiff. We're looking at why this is the largest supply loss in history and how it's going to hit your wallet. If you want to stay ahead of this chaos, hit that like button, share this with someone who needs to see the data, and subscribe so you never miss a briefing. But first, I need to hear from you. This is a global shift, and your boots on the ground perspective is vital. Are you already seeing $4 gas? Do you think the experts are right, or is this just a massive overreaction? Drop a comment below right now. I'm jumping in to read your theories, and I can't wait to see what you think. Let's get into the data.
Right. So to really frame our mission for this deep dive, we have to kind of strip away the initial panic. We need to look strictly at the mechanics of this $100 a barrel milestone.
Yeah, totally.
Because what we're really unpacking today are the latest updates regarding, well, a highly specific geostrategic gridlock in the Middle East. That's what is driving this massive surge.
Right.
Our objective is to dissect the structural realities of the market right now, from the physical constraints on global shipping routes to the exact economic domino effect being forecasted by top financial analysts.
So we're looking past the headlines.
Exactly. I mean, this is about mapping the data behind the momentum.
Well, let's trace that timeline immediately because the ground reality is moving incredibly fast. Based on the latest news, it has been exactly 1 week since the U.S. and Israel attacked Iran. And the immediate physical result of that action is that traffic through the Strait of Hormuz is just heavily constrained right now.
Heavily constrained is almost an understatement.
Right, and when the world's most critical energy choke point gets choked off, the ripple effects hit the actual producers almost instantly.
Yeah, they do.
We are seeing major Gulf oil producers literally running out of physical storage capacity because when the tankers cannot safely navigate the strait to move the oil out,
those massive onshore storage tanks just fill up to the brim.
Exactly. The producers have nowhere else to put the oil, so they're being forced into what the industry calls shut-ins. They have to actively cut their actual crude output.
And we really need to understand the sheer scale of those forced output cuts. Bob McNally, the president of Rapid Energy, provided an analysis that puts this into a very stark historical context.
What did he compare it to?
Well, he points out that the current disruption is far more severe than the 1956 to 1957 Suez Crisis.
Wow, okay.
And historically, that Suez Crisis has been the benchmark for a maximum market disruption. It's the absolute worst-case scenario that models are built on.
So we're blowing past the worst-case models.
Completely. The recent info indicates we are looking at the largest oil supply loss in history. We're beating that historical Suez benchmark by a factor of 2.
A factor of 2? That's wild.
It is. But the most alarming data point in McNally's warning isn't just the sheer volume of lost supply. It's the fact that, unlike previous historical crises, there is currently zero spare capacity available in the global market right now.
Zero. I mean, that is a staggering metric. Zero spare capacity means there is absolutely no global shock absorber.
None at all.
If another region could simply pump more oil to offset the loss in the Gulf, the market might stabilize, but that buffer is completely gone.
Yeah, and you can see that realization violently hitting the trading floors. We are tracking a genuinely historic reaction in the futures market today.
Right. Jim Bianco from Bianco Research brought forward a critical development regarding this. He noted that Monday's trading session could mark the single biggest one-day rise in the entire history of crude oil futures.
And for anyone who isn't, staring at Bloomberg terminals all day, let's frame why that specific phrasing matters.
Please do.
So, futures trading for crude oil, where investors buy and sell contracts betting on the future price of the commodity that wasn't actually standardized until the 1980s.
Ah, okay. So during the massive Arab oil embargo of the 1970s.
Exactly. We certainly saw large single-day price moves in the physical market back then,
Right.
But there were no listed crude futures contracts to trade in the way we do today.
Right.
So in the modern financial architecture, a spike of this magnitude happening in a single day has just never been stress-tested before.
The panic in that paper market is really a direct reflection of the physical geostrategic deadlock. Because the market is a forward-looking mechanism.
Always.
It aggressively searches for a diplomatic off-ramp or any signal that a constraint will be temporary so it can price the asset accordingly.
But the latest news dictates that an off-ramp simply does not exist right now.
No. We are seeing political bottlenecks that are essentially cementing the physical shipping constraints.
Let's examine the specific leadership postures creating that gridlock. The latest updates show Donald Trump publicly calling for Iran's unconditional surrender.
Right.
Simultaneously, the political equation in Iran has shifted. They have just selected Ayatollah Khamenei's son as the new supreme leader.
And he is widely recognized as a hardliner.
He is. When traders look at those two opposing realities, they don't see posturing. They see a locked door. Paul Krugman has warned explicitly about these specific political bottlenecks, erasing any hopes of a quick diplomatic resolution.
And Warren Patterson, the head of commodities strategy at ING, reinforces that exact sentiment. He points out that the total lack of de-escalation happening alongside those massive production shut-ins we just talked about changes the fundamental math for investors.
Yeah, they can no longer treat this as a temporary hiccup in the supply chain. The market is being forced to aggressively price in a prolonged supply disruption.
Which brings us to a vital economic principle that Krugman highlighted regarding prolonged disruptions, the concept of a nonlinear impact. Can you break that down for us? What does nonlinear mean for the everyday supply chain?
So it means the damage to the global supply chain does not scale evenly day by day. If the strait is closed for 2 weeks, the economic fallout isn't just twice as bad as being closed for 1 week.
It compounds.
Exactly. The longer those critical shipping lanes remain paralyzed, the disproportionately worse the damage becomes. Inventories at refineries deplete to zero. Secondary supply chains that rely on petroleum products fracture.
And the systemic damage accelerates at a steeper and steeper curve the longer the delay lasts.
Spot on.
I want to bridge that concept of cascading nonlinear damage directly to the listener's wallet. Because empty shelves and fractured supply chains are exactly what drive consumer prices up at the register.
Yeah, the economic domino effect we are tracking in 2026 is moving at breakneck speed. Oil prices have nearly doubled in just over 3 months.
Just 3 months.
And for the foundational commodity that powers global logistics, manufacturing, and transportation, a move that violent instantly threatens the broader economy.
The immediate fear radiating through financial markets right now is the threat of stagflation.
Yes. Ed Yardeni, a veteran market strategist, is looking at the latest data and warning about a full replay of the 1970s.
And stagflation is essentially the worst of both worlds for an economy. It's an era where severe energy shortages send consumer prices skyrocketing, while the broader economic growth is simultaneously suffocating.
To quantify that anxiety, Yardeni points to prediction markets. If you look at platforms like Polymarket, where individuals place actual monetary bets on real-world outcomes, the odds of a recession are currently climbing to a 3-month high.
Yardeni's assessment is incredibly blunt, isn't it?
Very. He states that this macroeconomic shock will not end until physical ships can freely navigate the Strait of Hormuz again. Until that physical movement is restored, a severe bear market or a recession remains a highly probable outcome.
And Mark Zandi, the chief economist at Moody's Analytics, brings that macro warning all the way down to the individual consumer level.
Right. He notes that this Middle East turmoil is going to severely squeeze lower and middle-income Americans.
The timeline for that hit is very short. Zandi specifically warns that we could quickly see $4 a gallon for fuel.
And when everyday commuters are suddenly paying $4 a gallon just to get to work, that massive financial weight drags down overall consumer sentiment immensely.
Which in turn stifles retail spending across the board.
Exactly. And that drag on consumer spending bleeds directly into how central banks are forced to react. Peter Malmqvist, an accounting investigator at the Swedish Financial Reporting Supervision Council, ran the calculations on this.
What did he find?
He looked at the broader economic impact of oil breaking the $100 barrier. His data suggests that the sustained price level could drive broader inflation up by a full percentage point.
A full percentage point jump in global inflation right now is the absolute last thing central bankers want to face.
Because central banks have one primary tool to fight inflation, and that is raising interest rates.
Right. Malmquist notes that this energy-driven inflation will heavily pressure central banks to hike interest rates again.
But hiking rates into an economy that is already slowing down because of high energy costs is incredibly dangerous.
If they are forced to do that, Malmquist warns we risk a massive global stock market correction.
Now, this is where we need to look at a highly nuanced, counterintuitive warning from Peter Schiff.
He's the chief economist at Euro-Pacific Asset Management.
Yes. You look at $100 oil and immediately think the direct result is massive runaway inflation.
Right. It feels like simple cause and effect.
It does. But Schiff is looking a step further down the chessboard. He argues that soaring oil prices will not, by themselves, directly cause higher inflation.
Wait, how does that work?
His theory is that the primary effect of an oil shock is actually a recession. High energy prices act as a massive, unavoidable tax on the entire global economy. It slows manufacturing, it destroys consumer demand, and it triggers a recession.
Let me make sure we are dissecting this properly. It's like the oil shock is the car crash, but the actual lasting inflation is the damage done by the tow truck dragging the economy out of the ditch.
That is a perfect framework for his theory.
So Schiff is saying the structural inflation will actually stem from the government's response to the recession, not the oil itself.
Yes. When the global economy inevitably slows down due to the crushing weight of the oil shock, governments will panic. They will deploy massive fiscal stimulus packages.
And central banks will reverse course. They'll deploy loose monetary policies, printing money and slashing rates to try and rescue the dying economy.
Exactly. Schiff warns that it is the secondary reaction, the desperate policy shifts, and the influx of newly printed money designed to combat the slowdown that will cause the subsequent uncontrollable surge in higher inflation.
Wow. So the initial shock destroys demand, triggering a recession, and the panicked government stimulus trying to fix that recession is what ultimately pours gasoline on the inflation fire.
That is a vital distinction for understanding how this might play out over the next few years.
It really is. But in the interest of examining all the data points from the recent news, we need to acknowledge the contrarian view here.
Right.
Not every analyst is predicting an apocalyptic, endless downward spiral. Robin Brooks, a senior fellow at the Brookings Institution and former chief foreign exchange strategist at Goldman Sachs, offers a very grounded perspective on how high this panic can realistically go.
He does. He acknowledges that the markets are currently in full panic mode. However, he argues that the upside for oil prices from this current peak is actually quite limited.
What is his rationale for that?
The logic relies on physical limitations. The financial markets were arguably slow to price in the de facto closure of the Strait of Hormuz, but now that it's closed, it is completely closed. Brooks points out the absolute physical reality. The strait simply cannot get more closed than it currently is. The ultimate geographical bottleneck has been reached.
Wait, if Brooks is saying the strait can't get more closed, isn't that just a silver lining based on a technicality? The global market is still physically trapped.
It is a technicality, but it's a vital one for pricing an asset. Markets trade on the probability of things getting worse or better. Because the ultimate physical bottleneck has been reached, Brooks argues that the situation can technically only get more open from here.
I see.
Therefore, investors who are blindly chasing this massive price spike, assuming it will double again, are ignoring the physical limits of the disruption.
That makes sense. And Paul Krugman adds another layer of caution against total economic panic, focusing on how our economies are structured today versus the historical benchmarks.
Right. While he did warn about the nonlinear damage to the supply chain earlier, he also points out a structural difference between 2026 and the 1970s.
Krugman notes that advanced economies today are simply less vulnerable to oil shocks than they were 50 years ago.
And the data supports that resilience. The shift in the industrial makeup of these economies is massive. We've transitioned heavily from manufacturing-based economies to service-based economies, which inherently require less crude oil to function.
Furthermore, decades of advancements in energy efficiency and the integration of alternative energy sources mean our baseline dependency is different.
Right. Krugman suggests that because of these structural shifts, it might be premature to definitively declare that a severe global recession is locked in.
But even if we assume that best-case scenario, even if Brooks is accurate that the panic has peaked because the strait can't get any more closed, and Krugman is right that modern economies are resilient enough to absorb the initial blow, we still have to face the physical reality of untangling the mess.
We do. Let's assume the geostrategic gridlock miraculously vanishes tomorrow morning and the strait reopens. Felipe Elankshurman, the CEO of Sparta Commodities, makes it very clear that you cannot just flip a switch and turn the global oil supply back on.
Yeah, his data points are perhaps the most sobering of the entire analysis because they detail the logistical nightmare of restarting an entirely frozen supply chain.
The fallout from this disruption has infected every single node of the energy network. First, the global ports have to entirely reschedule thousands of delayed shipments, clearing a massive maritime traffic jam.
Huge undertaking.
And second, you have the upstream production. Those major Gulf producers who were forced to shut in their output because their storage tanks were full, they have to physically ramp their extraction operations back up, which is a complex, delicate engineering process.
Let's dive into the reality of the refinery side, too, because Sherman brings up a critical point there. A refinery isn't a kitchen faucet.
No, definitely not.
You can't just turn it down to a trickle and then blast it back to full volume the next day. Refineries require immense heat, extreme pressure, and a massive continuous physical flow of crude oil to function without damaging their own infrastructure. They cannot operate efficiently at 10% capacity while waiting for delayed ships to arrive. They need a steady, uninterrupted flow of crude before they can even commit to resuming full operations.
And that operational requirement is the ultimate bottleneck for the restart.
Yes. Sherman's final warning is that even if the Strait of Hormuz reopens immediately and the political gridlock ends today, the normalization of the global oil market will take months, not days.
The time required to reschedule the courts, restart the wells, and establish that steady flow to the refineries means the economic pain is going to linger long after the geopolitical headlines fade.
Exactly right.
All right, let's do a quick razor-sharp recap of the perfect storm we are tracking in this deep dive. We're looking at the largest oil supply loss in history, paired with zero spare capacity. We have the total geopolitical gridlock preventing any quick diplomatic fix.
And we are tracking a domino effect that is threatening to trigger a severe recession, 4 central bank rate hikes, and hit the consumer directly with $4 gas, all while knowing that a physical restart of the system will take months to achieve.
That's the stark reality of the data.
Thank you all so much for listening to or watching this deep dive. If you want to stay ahead of these macro shifts, be sure to check out and listen to the other podcasts on our channel for more expert briefings.
If a single geographic choke point can paralyze the global economy and require months just to untangle the logistics once reopened, are we looking at the end of the globalized energy market as we know it and the forced beginning of a completely localized energy era?
Thanks for tuning in. See you in the next one.